One only has to look at your share price performance to see how the market responded to those numbers, increasing by around 2% for today. Let's start off with the environment in which you operated during that period. Clearly a far better consumer.
I must say, yes, thank you for having me on your show. We found the environment much better. Customers seem to be paying their accounts very well, and especially as we got into the October, November, December period, business picked up nicely, and across the board, most of our brands performed very well.
Well, Michael, one of the things that people keep talking about are your margins, because they are very high. They're sitting at above 36% or so. And a question that keeps coming to the fore is whether you can maintain these margins going forward. What is your strategy, given the fact that margins globally are still becoming squeezed?
Yes, that debate has been raging about Truworths margins for the last 15 years. I remember when the margin was 17% instead of the current 36%. There was a lot of debate as to whether it could get higher. We really run the business on the basis of saying that we have to try and keep our expenses as far as possible below 10% and keep our sales growth 12%, 11, 13, as much as we can around that area, and keep our markdowns under control, and then the margins will remain intact. And we've been able to do that successfully for a long period of time. It's not a new thing. It's been going increasing slowly over the last 10, 15 years. It doesn't go up suddenly. It increases by 0.5% or a bit less every year. And perhaps we've reached a plateau now, but I don't think it's going to decline in the foreseeable future unless we buy bad merchandise.
Well, tell us a little bit about your export mix, or import mix rather. When you look at a local currency that was very strong last year, and we know that CMTs overseas are far cheaper, and with a local currency at these levels, it obviously makes more sense to import a lot of your products. Tell us about that mix last year.
Well, there's certain product categories that you have to import because they really are not made in South Africa at the level and the way you want it. For example, there's some kind of denim products, especially when you have a lot of treatment on the denim. There's certain types of knitwear, and there's certain types of detailed embroidery and certain types of product that really you have to import, because if it was made locally at all, then it would be prohibitively expensive. So there has been an increase in the Chinese import quantities over the last 5 years, and we're now sitting at about 55% import and about 45% local, somewhere around there. But it didn't change particularly this last 6 months. The next 6 months, there is much greater inflation, especially from China.
We're looking at the M&A side of things as well, and you have said that there could be a potential deal going forward. Some analysts say really difficult to read into which would perhaps fit in your company. Can you give us an indication of what we're looking at into 2011 from a mergers and acquisition perspective?
Well, as you I know are aware, we have almost 2 billion rand cash on our balance sheets, and we're ungeared. So we are, of course, looking for acquisitions and opportunities, one of which is to buy back our own shares. We have already, over the last 10 years, spent 2 billion rand in buying back our own shares. There are businesses available in South Africa and abroad that perhaps would appeal to us because they would add a synergy to what we currently do and add breadth to our range, but the same customers. Of course, I can't speculate which ones there are, but we look at them, and over time one hopes that one day the opportunity presents itself to talk about an M&A transaction.
Michael, well done on a great set of results, and it's also good to know that you'll be staying on a bit longer too, I think until at least 2013, which I think will probably make you one of the longest-lived CEOs in the country, and the results speak for themselves. Michael, also just with respect to your business, sort of credit granting, you still seem to be extremely cautious about that. You are granting credit, but you're extremely careful as to who you grant it to. So it's not as though you're letting that do the talking at the expense of future trouble down the line.
Yes, that's an excellent point. The thing we've learned over the years in the matter of running our business is to be consistent and to run it with the same strategy and philosophy, irrespective of what the economic conditions are. So we don't play games with our book. We We have a philosophy and we have an approach to how we lend money to our customers, and we stick to that as much as we are able to all the time. And we always have found that the best way to run our book is to be conservative, to be restrictive as to how much credit to give to whom, to be very responsible about it. And it works for us. So, yes, we're not being aggressive at the moment.
Michael, very quickly, you say for the first 8 weeks of the second half of the 2011 financial year, we saw sales increasing by 9.8%, so softer than what we saw in the previous period. Does that mean we could see a tapering off going forward into 2011?
Well, that's the complication. We never know in our business what's coming down the track. When it seems to be very exciting and good, that's when you get a surprise the other way around, and it's sometimes more positive than you expected. The 9.8%, however, for the first 8 weeks relates more to the fact that we had less markdown merchandise than we had the year before. So that's that reason. But we are cautious about the next 6 months, and I think reaching the same level of sales that we did in the first 6 months will be difficult.
Michael, is it likely that you'll stay within the same ambit of brands that you have within the stable, or do you think it's likely that you could possibly venture outside of what we all know so well and maybe look at other names, or possibly even bringing in branding from outside SA?
Branding outside South Africa is a possibility. If you're meaning there, take our existing brands and open up operations internationally, that is a thought we often have. The second one is, yes, small acquisitions, not too risky abroad, are possibilities, as long as they're in the same territory or fashion that we understand so well. Within South Africa, acquisitions that relate to our customers, but not necessarily exactly the same product type, but perhaps allied as a product category, is a possibility.